Number 4, what is your strategy? Now again, everything that I talk about is just for example purposes. I'm not telling you what to invest in. There's 2 ways to go about investing your money in the stock market. You can invest into a fund, something like the S&P 500, or you can invest into an individual company like XYZ Corp. If you invest in the S&P 500, you're investing in the 500 largest companies in the stock market. You're essentially just investing in the stock market. Here you're investing in an individual company. Here, this company can go bankrupt, but it can also make a lot of money. So if you're investing in this company, markets are going down, it can create a good buying opportunity, assuming that this company goes back up, they continue innovating and they make more money. But if they go bankrupt, you then lose all of your money. So higher risk, higher return. This is the right way to go for some people, but for most people, this is not the right thing to do, which is why I say 98% of people should not be buying individual companies. This is reserved for 2% of people who are interested in this, who want to spend the time researching this, who want to spend the time learning about this, and who want to spend the time actually keeping up with this and have the psychology to manage this as well, because the reality is markets go up and they go down, and sometimes you'll see wild swings in the stock market. The Amazon stock fell by 90% when the 2000 dot-com bubble burst. It takes a lot of patience and a lot of strong psychology belief to hold on to a stock when you see it go down by 90% and not know if it's going to go back up. So it takes a lot of understanding of the fundamentals of investing if you want to be investing in individual companies, especially when things go down. The alternative is you can invest in a fund like the S&P 500. Now, the interesting thing about this is XYZ Corp might be one of the companies in the S&P 500. And if XYZ Corp goes bankrupt, well, then it'll get kicked out of this fund and be replaced by somebody else. So your risk is a little bit lower, but your upside is also a little bit lower as well. But now, when you look for opportunities, it's a little bit easier, less time intensive, less work, less risk. And now, when you see markets go down, it could be an opportunity for you just to invest your money into the stock market. This is one way to do that. There are funds that give you exposure to the S&P 500. For example, if you invest in SPY, this is a ticker symbol of an ETF that gives you exposure to the S&P 500. Not telling you what to invest in, just an example. You could also invest in a ticker symbol like VTI. If you invest in the VTI fund, this will give you exposure to the total stock market. So now, if you know what it is that you want to invest in, it's a little bit easier because when you see downturns, they create opportunities. Now, of course, there's the chance that markets will never go back up. Then you lose money. But if you believe in the future of the American economy, if you believe that the stock market is going to continue to rally in 5 years or 10 years or 20 years, well, then it creates a good buying opportunity because that means you can buy a piece of the economy while it's on sale. So you have to understand what it is that you're investing in. And if you believe in the future of the economy, down days create opportunities. This is why I say recessions and market crashes create more millionaires than any other time, because they create opportunities for you to come in. If you're financially savvy, if you're patient, and you're prepared, meaning you have cash, you can then come in and purchase some of these investments at a huge discounted price. But you have to know your strategy, and this is something you want to be thinking about before you see a downturn in the economy. Now, I also want to say this. We know the markets go up and down, but you don't have to wait for a down day to start your investing journey. What Warren Buffett says, one of the greatest investors of all time, is that time in the markets beats time in the markets. People who time the market end up missing the bottom, and then they end up selling too late. And the reason why is because when markets go down, you always think that it's going to go down a little bit more. And you're waiting for that perfect time to come in and buy. And then you miss it and it starts to go up, and now you say it's too expensive. And then 6 months go by, you wish you would have bought it when you thought it was too expensive because now it's way more expensive. And then another 6 months go by, and then you wish you would have bought it 6 months ago. That's the common trend. It's the same thing when it comes to selling. Every time you think about selling, you think, well, what if the stock goes up just another 5%? Then I'll sell. And you're waiting for that perfect opportunity, and that's why so many people end up losing, because you're trying to perfectly time the top, you're perfectly trying to time the bottom, and you end up missing. When you're investing into funds like this, one of the simplest things that you can do is set up an automatic investing strategy. It's called dollar cost averaging, where now every week or every 2 weeks or every month, you're just passively investing your money into these funds. It's automatic, it's consistent, it's passive, you don't got to worry about it, and it happens on autopilot. The only thing you change now is when markets go down, you can invest a little bit more aggressively. That way you can accumulate more shares of something that you believe in for the long term. And it's got to be something that you believe in, because if you don't believe in it, why are you investing in it in the first place? Just because a random person on the internet said so? Not a very good reason. Do your own research, do your own due diligence, and only invest in things that you personally believe in and are willing to lose money on, Which brings me to point number 5, which is understanding your finances when it comes to investing. What I learned over this last week and a half is that many people have turned their stock brokerage into a separate checkings account. That you put some money in here and you're hoping that by next week you'll be able to turn your $1,000 into $1,020, so you have a little bit extra money to pay for your expenses. And that is not what you want to do with your stock market portfolio or really any investing portfolio. Your investment portfolio is separate than your spending money. Okay, you got to have savings money, you got to have investment money, and you got to have spending money. Separate these things. Create separate accounts, separate bank accounts for each one of these things, and treat them very differently. Your investment money is something that you got to be able to let go of. Do not invest money that you're not willing to lose. If you need that money next week, if you need that money next month, don't put it in the stock market. When you invest your money, whether it's the stock market, whether it's real estate, whether it's startups, whether it's gold, whether it's cryptocurrency, I don't care what you're investing in. If you're going to be investing that money, you got to understand you're parting ways with that money for years, if not decades. That's the mindset that you got to have, that your money actually has time to grow. Remember, part 1, crazy happens. We know that crazy is a part of the market. If crazy is a part of the market, you got to be able to adjust that into your portfolio. So if crazy happens, you got to let crazy happen and adjust for that. Allow time for the crazy to happen, because if you have time ahead of you, if you're in your 20s, if you're in your 30s, if you're in your 40s, even if you're in your 50s, you got time ahead of you. Let the markets do their thing. And if you're not planning on touching the money for 5 years or 10 years or 15 years or 20 years or 30 years, why are you freaking out over what's happening over the course of a week? Especially if you continue to believe in the economy that you're investing in. If you don't believe in the economy that you're investing in, if you think the American economy is going to collapse, why are you investing in the stock market in the first place? So you're investing in stocks because you believe in the American economy. And if you believe in the American economy and you're investing for the long term, which is more than 6 months, why are you freaking out when something happens over the course of a day, a week, a month, even a year? Let the markets do their thing. Use the crazy as an opportunity. If you're investing in good assets, do your financial education, be prepared, pay attention to financial trends. That way you can find the opportunity and use the craziness as an opportunity to build more wealth, not to build more fear and panic. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.